Imagine two students each receive $20,000 to help pay for college. One receives a scholarship and grants, and the other relies on loans. Both walk onto campus with the same amount of money available for tuition. 4 years later, their financial futures look completely different. Why? Because not all financial aid is created equal. Welcome to Paladin Financial Talk. I'm your host, Nikki Foley, and today I'm joined by featured guest William Nusser. He is an enrolled agent and owner of Simmons and Simmons Public Accountants. And today we're unpacking the rules, the tax consequences, the repayment requirements, and plenty of planning opportunities behind scholarships, grants, work study programs, and of course, student loans. Welcome to the show, William.
Thank you for having me, Nikki.
Absolutely. Okay, William. So our topic today is part of a series that we have been doing for this entire month, and you're our fourth or fifth guest that we're having. But yours is, you are getting into the real detail here. And so as part of this series, we have been exploring how families navigate education, financial decisions, leadership development, and that all kind of plays into what life looks like beyond the classroom for these students. But today we are going to talk about the college funding portion of it. And you have the best perspective on the impact of taxes and what that might look like. So let's talk a little bit about your background here. You are the owner of Simmons and Simmons Public Accountants. We've just finished our first tax season together.
Yeah.
And so that has been fantastic. And we're sitting here together face to face. So you're visiting us in Minnesota. We have our client event tonight, client appreciation event tonight. And so you're here to mix and mingle with everybody after a big tax season. And so I'm just glad you're here. I'm glad we have this time together today.
Yeah, I'm really looking forward to it. Looks like the event tonight's going to be a lot of fun. So who doesn't enjoy some time out in the community and seeing clients and that appreciation? That's kind of a lot of times we're in the weeds going through, and taxes aren't always the funnest conversations to have with people, but sometimes to get to meet them and know who they are outwards. That's what we're really focused as a firm. I think you guys do a great job too. We want you to know the firm you're working with and who we are, and that we're people and that we have a face to the name. So that's what's important, that we come up here and enjoy some time with the clients.
As you talk about that, I'm going to bring in something. It's a study from the University of Kansas that I went over this, probably at this point, almost 3 years ago on our program, that to get to know people as an adult, people often complain it's hard to make new friends as you age. And this study by the University of Kansas was done, I think, actually by I think it might have been their psychology department. If not, it's by the communications department. It felt a little bit weird of where it was coming out of. But the point is, it takes a certain amount of hours with an adult to create a new friendship. And so like ring one or tier one of that was like 8 hours. And then it's 16 and 30 and so forth. And think about it as an adult, how often is it that you're spending 8 hours or 16 hours with another adult? It just doesn't happen like it used to as a child or as a student. And I bring that up because hosting events like client education events or client appreciation events gives us an opportunity to have real conversations outside of, maybe the workplace conversation that we have about their finances, and it's across the table once a year. And so we certainly look forward to these events. And that's one of the reasons that we put them on, is so that we have an opportunity to get to know each other.
And a lot of that too is being on the same side of the table, versus on the advisor to the client relationship, that we normally are on. When you cross over and you're on that same side of the table, you're staying there just discussing. It's a little easier to have just more common conversation than, hey, we're here for this task again, I have another appointment here coming up, so let's get through this. I think it's important just to know who they are, because for us guiding, a lot of it isn't just the numbers or what's going on, it's emotional. It's emotional with family. When we talk about college here in a little bit, there's a piece to that, is the uncertainty. So understanding where they're coming from is very critical to our role as advisors in the tax world, but also accounting when you're business owners of that. We're talking, even had a client call me this morning, there's some structures they're trying to look at in their business and change. And some of it is emotional. It's not just the nature of what's this building worth and what am I going to get? What are the taxes? There's an emotional component to a lot of what we do, and making sure you're walking them through those steps until you get there. And that's what's important.
Yeah. So absolutely, spending the time together is a big piece of who we are as an organization. And so we're looking forward tonight. We are at the Forgotten Star Brewery. We've been doing the same event for the last few years. We have Nelson's Ice Cream is famous. It's from Stillwater, and they have another location here in the Twin Cities, but they give these enormous scoops of ice cream. And so everybody loves that part. We're doing music bingo this year. We have food trucks. And so it's a fun event for everybody just to kick back and enjoy. So, well, with that, should we go ahead
Yeah.
and get started and dive into the conversation? And so I have to have structure around our conversation. I feel like you can go all over the place
Yeah.
with the topic of financial aid. And so I'm going to start with the first piece that I want to point out is a parent claiming a child as a dependent versus a student filing independently. Pros and cons, and that's not as easy to achieve as one might think. And
Yeah.
so I want to start with that, and then we'll get more into all the different categories of how you might earn financial aid or receive financial aid. But let's start with this scenario of why can't I just start claiming myself and move on?
Yeah, and there's a couple pieces there. A lot of times when that kid graduates high school, they're like, "Well, you're on your own now." It's like,
Yeah.
well, no, actually, the parent can still claim through the college years. That's the first step. There is eligibility there, and then secondarily, you can't just decide that you're independent. I mean, they probably feel independent when we graduate high school, but you actually have to support yourself. So there's a couple tests the IRS has in regards to claiming dependency, and you'd have those same rulings between when you're an infant and born, and maybe we're looking at which parent's going to claim all the way through college. You got to have the support test. That's providing over half the support. So you have housing, food, vehicle, all those pieces. If you're going to claim yourself, you have to prove you're providing over half your support. And taking sometimes these scholarship monies and those student loan monies do not count as support. So that's what's
Okay.
important, that they want to see you're providing your own support. And the reason for that in the FAFSA world is if you try to claim yourself and you're proving you're claiming yourself and you're low income, well, then you start becoming eligible for other things. So that's
Yeah.
why they're pretty critical of understanding, like, hey, your parents are supporting you. Yeah, you may have a job to go out. So when you go out tonight, you can pay for your own things. But really, when it trues to paying for the things that matter, room, board, housing, car, cell phone, health insurance,
Yeah.
medical costs, that's what they're looking at, true support. Just because you went out tonight and paid for your hamburger doesn't count that you're supporting yourself.
Yeah. What a good perspective that you provided there, that I didn't realize scholarships and some of these items do not count
Yep.
as supporting yourself. And we may get into that again. But okay, so the support test is one. I think you mentioned residency
Yep.
before we got together as well.
Yeah, yeah. So when they look at residing, so when you're also claiming a dependent, they want to make sure you're staying over half the nights with them. Now, in the college setting, they're allowing, because it is temporary housing, that you're able to stay somewhere and still be considered residing with your parent. But in a situation, if you have a split household where the mother and father may no longer be together, that house support thing becomes critical. If you're a parent that's doing every other weekend, you're not going to get over those half days. So that's the hard part you got to kind of look through. So if we have situations where it's critical, we're trying to see who's going to claim, it's as simple as getting a calendar out there and circling those days. What did they say? And then as you get to college age, it's a little different, but you're allowed to use that dormitory or college housing as considered as if they stayed in your home.
I thought we were starting with the basics, and I already feel like we were just diving right in. Some complications here. You had an example of one of our clients that I actually work with related to earned income that also plays into this conversation. And when you get to be a little bit older, which is happening now, especially for some of these athletes, age 24, age 23, go through that scenario as well.
Yeah, so it's important there when you get to certain rules of dependency, and that under 24 rules and over, there's income limitations you can make and still be eligible to be claimed. So when you're in that 19 to 20-year-old range, no issues about the amount of money you can make. It's limitless. But once you start getting to older, like the idea of, let's say you have, even outside of college, someone that's a special needs, where they're always going to be at the home, you may not be able to claim them even though you're providing some support because of some items there. Now, the special needs gets another layer of rules we get into, but just when you get to certain ages, there's income limitations, what they can make also. So if you're a college athlete or you're just working a little part-time job, as you get later in your college career, if you're thinking about grad school or any of these other deals, those rules can change quite a bit when we look at dependency and what's going to go on there.
Okay, so right out of the gates, we've come out with 3 strong things that you've shared. There's support test, the residency or where you are residing, the earned in or the income or the age, and then that plays into the income. Anything else that would play into this perspective that they should be aware of?
It's just really critical, I think, at a point when you're looking at, if you got a college age dependent or soon to be college age dependent, starting those conversations during your tax appointments to make sure that we're putting ourselves in position, because one, FAFSA information, we're going to need to be current or accurate, and pre-planning. The hardest thing to do is when you're trying to unwind something that's already been in place. So making sure, if you think that college is going to be a part of an aspect into your dependent's future and your child's or even yourself, making sure you have those conversations before you're all the way in. And when we start talking about financial aid, and then you get 10 years later and you wish you would have done something different. I think that's what a lot we try to be on the front end versus the back end.
Yeah, absolutely. The conversation of planning. I am doing some coursework through the American College. It's one of the kind of the premier providers of coursework on the financial side. And in this most recent conversation or class that I'm going through, they were talking about how using savings versus loans, it's absolutely incredible the difference of what you pay versus, if you're paying back interest and the time that goes into that. And so it's a big deal to plan well ahead on some of this. Anytime the government is giving us money, it seems like there are usually some limitations that go along with that. Talk about that piece of it.
Yeah. So we look at, especially in the side of either loans and or like education credit side, that there's a lot of thresholds you're going to have to make sure you're crossing. There's hoops you're going to jump through. There's things you got to administer, but also there's going to be eligibility requirements. So when we look at adjusted gross income, and in this scenario, that's actually modified at adjusted gross because there's certain income scenarios that will add back in, you may or may not be eligible. My dad's old famous saying, when we were going to our college path was, well, the government says I can afford to pay for your college. I'm certain I can. And so that was his thing, is like, we tried and, we did do those loops, but there just wasn't eligibility there. And I remember him being pretty frustrated at the time because it's low today. Those AGI numbers, I don't think have adjusted as they should. When you're talking in the 160 married filing joint household number, that's not a ton, to work through if you're going to you're just trying to keep your household going at that point. You're not going to have that extra money for tuition and housing going through. So that was always his famous quote, that the government said he can afford it, because we didn't really get any assistance. And then, but he was certain that he could.
Yeah, so that's fantastic. All right. Well, those were some good ones right out of the gates. And like I said, I thought we were starting with the basics, but we've given some pretty rich information already. Well, let's move into now. Student financial aid generally falls into, I would say, four main categories. So scholarships, grants, work study programs, and student loans. And the way that I like to look at this, again, because my brain needs some structure around it here, is the who, what, where, when, and how of each of these categories. And so when I say that, as scholarships and grants oftentimes look fairly similar when it comes to this, but who is actually receiving the money? And then what does that look like from a taxable perspective and so forth? And so let's just start with the first category of scholarships. So these are oftentimes merit-based, meaning you're getting rewarded for some type of performance. Maybe that is achievements academically, or talents, could be athletically. And so let's go through who would receive the money if I get a scholarship, and walk through that.
Yeah, generally those speaking, especially when you're going on achievement or grade pieces, that the university is handling that within itself. So it's a little bit left pocket, right pocket. Okay, here's your scholarship. We're going to credit your account at the university. Not necessarily they're going to run through, probably the smart on their side, right? If you gave every academic and athletic scholarship to the student and then asked them to pay that back to you, probably wouldn't work that well for the university. So, but you're going to see that credit on your student account there. And primarily what's a big point of the scholarship piece, and the grants are similar in that run, it's going to come to you on a tax form. A 1098-T is going to come in. That's going to show what payments you have received or paid in, and then also what scholarships you've received, and it's going to know the cost of the university. So that's the piece in a primary document that we're using in your tax preparations, the 1098-T. So anytime you got a college-age student, it's your first year there, they're not great about mailing them out. The way today is they want that student to log in. So you got a student that's there, and what's kind of tricky about it is we go to school in August, right? First year, you're a freshman, you got a lot going on. Well, the tax year ends in December. So the school year tax year can be fairly confusing on that paperwork. So your student's there. He's only been there from August to December, kind of starting to figure things out. And then you are in your tax appointment going in, and we're talking through, and you're like, oh, well, Johnny's at Ohio State now. And you're like, well, we're going to need this 1098-T. And then you're texting the kid, trying to get him to log in and print off the form. And it's kind of always a fun thing. And he doesn't necessarily know, because he's still learning life. He's 18 and he's there. So that 1098-T form is a critical form that comes from and the university should provide that. I laugh. It has gotten a lot better. When we first started my career 15 years ago, that was a really inaccurate form. And the people are like, man, I just don't think these numbers are right. Well, I knew when I was at Washburn, we were preparing them. That was like one of the work study jobs,
Okay.
So I think the computer systems are a lot better then. I think there's a lot more data entry when we were doing, and that was a huge piece. We used to be there at the financial aid office, and they weren't very accurate forms at that point because all the students were preparing them. But I think the computers have done a lot better job on that. But those are cash basis, and what we see sometimes is timing. And so let's say that spring semester is coming. Well, that scholarship may hit December 30th, and then you don't pay that tuition till January. So it looks like your scholarships are in excess of the tuition, potentially a taxable event, or maybe not as education credit eligible as you would think. And so sometimes we'll have to get that history report there from that transaction, because when they fund your account, there's sometimes the timing of that when the tuition is actually charged, because a lot of times they don't charge it until after the first of the year. So that timing can have a little nuance to it.
Okay, so what I heard you say here, William, is yes, while the college is kind of moving money from left pocket to right pocket and back and forth here, you are going to have a tracking piece that goes along with that, and that is the 1098T form. And you may have to be a little more proactive with this to get it, or ask your student to get it. But it is a key piece, and it really is just documenting the fact that that your student received money.
Yeah, correct. And on the side there's a couple other pieces on the 1098T that are critical to when we get to the education credits. There's a box in there that says half-time student, which is important for the American Opportunity Credit. The university is basically deeming that you've met those thresholds for half-time student. Now, when we look at that, as when we were in college, you thought 12 hours was really our minimum. I need to be 15 to 18 to graduate. The half-time rules are like 6 and 9 hours. They're not what you would think of, hey, I need to be this full-time to graduate. So they're pretty soft, but it checks half-time student. It checks if you're a graduate student. So there's other pieces in there that we catch as practitioners to say, and IRS is also looking at to see which credit should you be eligible for, because generally speaking, as a graduate student, you wouldn't be eligible for American Opportunity because it's only good for the first 4 years of post-secondary education. So there's a lot of other nuance that goes in there. There's sometimes they'll have boxes checked that this includes numbers from the prior year, but a critical form for tax preparation, though, is that 1098T. Because you need the university EIN number, and there's a bunch of stuff on there.
Okay. You actually brought up another point that we probably should have covered in our first section there on, claiming somebody as a dependent versus filing independently. The American Opportunity Tax Credit. What other credits might be available out there?
So lifetime learning credit is the next primary on the federal side that you're going to see. American Opportunity Credit is the most lucrative. 100% of first 2,000, and then 25% of the next 2,000, max credit 2,500. Only 40% refundable though, so you want to make sure you have taxable income in order to be eligible for that side, and only eligible for first 4 years of post-secondary education. So that's a critical piece. And sometimes, and what's interesting about that is, let's say that person goes to college for 2 years, maybe they fall out, or they do a community college, they go work, and they do 2 more. Well, then you got to kind of like work these years of which tax years have you worked through there. It can be fairly complicated. Lifetime learning, more eligible, but 20% credit of the first 10,000 you spend. So max credit of 2,000. So you got to spend 10,000 to get 2 American Opportunity Credit. You can spend 4 to get 2,500.
I already feel like I need to work with a professional.
Yeah.
Feels like this is something that you should know. And I, maybe as a layperson might not be able to track all of this.
A huge piece to that is eligible expenses. And so when people think about that, well, I wrote the checks to universities, Well, that was for housing. The IRS doesn't give education credit for that. So when we talk about eligible expenses, it's tuition, books, and there are, for American Opportunity Credit, outside expenses. So if you have those laptops and school supplies, or I've even had airline pilot, like flight schools, where you get those hours. So those things are eligible, but they don't want to see room and board, which can get confusing when you are intermingled in your student account. Because let's say you were at Wisconsin University, then you're going to also have your room and board and housing built in that same account where you're billing. So they don't really distinguish, this is what you owe for school, this is what you owe for housing. They say, this is what you owe me. And then you've got to kind of unwind where those monies came from.
Okay, so let me make sure that I feel like I have good perspective here. So from a tax perspective, typically tuition, required fees, required books, required supplies, that would all be recognized. But something like housing, so room and board is oftentimes used, housing, meal plans, travel expenses, anything that kind of gets just on the peripheral, outside of that is not something that would be.
And that's what can be confusing for people sometimes, because those scholarship dollars, grant dollars, and student loan money can be used for all these things, but what's eligible for the tax credit, and you can just think in your mind, what is truly driven in the education side? These are education credits, not living credits. So they're designed around the education. So think about what really is there. And you're really driving off that 1098T. The 1098T is not going to include housing.
Okay.
Like when you think of costs you had or payments received, they're not going to include housing on that. It is just education. It's more driven towards the tax code.
I do feel like when you start to apply some general rule of thumbs, it becomes far more common sense. Where before, until you have some of those general rule of thumbs, you're like, well, of course I played room and board and I have to be there. Shouldn't that count? But what I heard you say is it is all about the educational piece. And so if you can tie it back to that, good chance that it'll apply. But you get into housing and living expenses, and unfortunately, it's
and
not.
sometimes we'll see those 1098Ts come where scholarships and grants are in excess of the education costs. So you're not going to have education credit eligibility because of maybe I'm an athlete and I got my room and board covered. Well, your scholarships and grants are going to be in excess of your school costs because of that component. And that's the only way you really see that. But that's why you see it that way. If you get any form of room and board support, it's coming on that 1098T. And so your eligibility for or tax credits are not there because that's how it's being covered. So
you had said one other thing that I just want to bring distinction to, that you want to make sure there's enough income, because when you get these credits, you get the credit, but if it's excess, it caps at a refund. Will you just go through that concept of that? Because sometimes this is probably not applicable to a parent when there's income, but it's more so a student.
Correct. Yeah. And so what they want to see on the side of one, let's give a little note of credit versus deduction. That's a world that we commonly get misconfused with clients. They think, is that deductible or is that a credit? A credit is like more withholding on your W-2. It's worth $1. So if I get $1 of credit, your true tax bill is going to be $1 less.
Okay.
Versus if I had $1 of deduction, well, then I'm taking my tax rate times that deduction, and maybe I'm going to save 30% of that dollar. I'm going to save 30 cents. So these are true credits. So they're worth dollars, but only so much of the credits are refundable. So if you had no taxable income, for example, American Opportunity at 40%, you're only going to get 40% of your credit and maybe not even any, depending on where your income threshold falls. So there's like a double-edged sword. I can't have too much income and not be eligible, but if I don't have enough, I'm not going to use the credit to my advantage. So that's when we look at a lot of times like, well, I want my kid to claim that credit. Well, the way standard deduction is involved, he may not have taxable income. The credit may not move his return one single penny. So those are the things that we like to in those settings, is having access to parent and student's return and making sure we're taking the best situation and what they are eligible for.
Yeah, and I think sometimes as people are doing calculations in their head, they forget about the standard deduction that then pushes everything down as well.
Yeah, and that's expanded so much. You know, we're not at $5,900 anymore. You know, so for a college student, they're there full time to make enough money to even get above the standard deduction today it's pretty tricky. You know, there aren't many college students that are making 20, 30,000 a year, you know, so that's what's tricky as you go through there.
Whew, I feel like we are just rich with information. I'm feeling good here. So, okay, we have covered from a perspective of scholarships. Really, grants look a whole lot like scholarships, except that grants are oftentimes need-based.
Scholarship is much more driven on maybe academic or athletic successes you've had. Grants are more driven on, frankly, on the federal side, they're just going to look at your parents' income. If it falls in this box, check the box, and this is what it's going to give you when you do your FAFSA forms, your Pell Grant eligibility, any of those pieces, and then you just figure your component out after that.
I feel like when it comes to a lot of this, working with the university, it is such a turnkey process, is that if you are far enough along with them, they are going to deliver what
I think you hope
aid's
that
gonna look like.
your financial advisors in the university world, they're very good. You hope, because obviously their job is trying to get the university paid. So the best universities have the best people in those roles, because that's how they get their bills paid. So definitely work with the university, not only in the academic advising, but also in the financial advising, and taking those times, not when you're walking on campus, taking it when you're a junior and senior in high school, taking those trips with your family and starting to paint that picture, because you need to know and understand what the costs are going to be.
Back to one of our first guests that we had was a graduating college senior. And one of the perspectives that she shared was she didn't know right up until the time she was going to college what her responsibility was going to be. And it wasn't, I think you just don't know until you know what the numbers are going to be. And so it's come up a couple times since then, of the more that you can include your student in the conversation, and as early as you can include them, then everybody has a much better chance of figuring out how you're going to pay the bills and how you're going to make all this work. And back to the conversation we had earlier is, let's make sure that we're doing it through a planning perspective versus kind of on the reverse and trying to play catch up because you're playing so much more when you get into loans and having to pay things back. And that's where we're going here in a moment. Before we get to student loans, let's talk just quickly about the work study program. And that really does look like a job.
Yeah.
It's a W-2 wage. Is that correct?
Yeah, correct. Yeah, it's going to come as a W-2, and it really doesn't. It looks a little different on our end, but really, it's just a job. You're earning your money, so don't feel like sometimes people they find out. Well, I signed up for work study, and that's how I'm paying for my school. In essence, yes, but they're paying you, and then you pay it through that direction. So it's earned income. So you're going to subject to the same rules as anyone else if you had any other job. It's just the university is kind of administering. A lot of the work study programs used for maybe international students too, and that side to give them opportunity to kind of go through on that side that maybe not have been eligible to work at other places too.
When we were just having a quick conversation before we started, you said there's some things to at least be paying attention to if you are going to be a part of a work study program. Not the end of the world with any of these. It's just more of an awareness, but are they withholding federal and state taxes? Does this count towards Social Security? Will you just go through a couple high level points?
Yeah, just on that side for there that just make sure anytime you're dependent of another and you're working, discussing to see if I'm not going to meet that standard deduction we talked about, instead of withholding money and then having to come in, pay to get a return prep to get the money back, you can sometimes do exempt. If we know I'm only going to make in this small threshold, I don't need federal and state withholding, but just watching and have that discussion, work with your parent or your parent help your student with getting with the tax preparer to say, hey, he's started to work now. This is what he's making. Because we try to help our clients. We don't charge a large fee to do the kid return, but in essence, you wouldn't have to file it if we would have just been exempt on the front end. We could have saved everyone a lot of energy and time. The kid gets more take-home pay. That's really what they're wanting to do, right? They're needing to go through and buy that little can of pop or buy some goodies. Like instead of having that federal withhold taxes when we didn't need to, and then file a return to get your money back, we could have just not had it withheld on the front end. So that W-4 planning on the front end is important.
I do feel like that's a topic that people really don't know how to fill out their W-4. It's just confusing
it got way
for
more
people.
complicated in 2016. That W-4 is I think a problematic document today. They saw some adjustments, and I remember in a show once that first year that came out, there's a lot of push from the administration saying, you're getting a large net paycheck. Have you noticed that? In the back of our mind, we're saying they haven't changed the tax law.
Okay.
And when tax season came, everyone's tax position was a lot different because we took that money already during the year. So we're starting to see a little bit change of adjustment there, that we're getting better to what people expect. But that planning is so much more it's a 4-page document now. It used to be one. It used to have like single, and you do 1, 2, 3, 4, right? And then you could kind of just say or zero. And I used to say single, zero, big refund, 1, you're getting close, 2's even, 3, you're going to owe.
Okay.
Well, now it's got 2 jobs, 1 jobs, and you're wire. And people, so now what they're doing, they're writing their name on the top and they're signing on the bottom. They're hoping, So, that's the point we do a lot. And we try to plan if people are surprised or we're not happy where the tax position is at the end of the year, we try to make sure we can get those adjusted to soften that a little bit. But on student and jobs now, that's so, I would say the 90% of people filling them out have no clue what that means.
I would agree with that.
If not more.
And so for a student, oftentimes everybody's situation is different, but it may be a situation as
you put exempt on the W-4, and so, but being in conversation when you're doing that and saying, hey, this is what I'm going to do. You roughly know how many hours you're going to work, what you're going to do. And a lot of times we see exempt, it's just a better thing to do. Instead of having to then file and get it back and get a hold of the student. Now they're over 18, so they got to sign for themselves. And it's just a lot simpler just to have them not have withheld.
Okay, I'm moving us on to the student loans here. And this is where I want to bring some distinction to things. So the first thing when we talk about student loans is federal versus private loans. And so hopefully that has some basic context already around it. But before we go into some differences on federal and private student loans, I want to talk about the terminology subsidized versus unsubsidized. And that really applies to federal loans when we're talking about things. And then it's talking about the interest portion. And so just a little bit before I get back into your role here and talking about some of this, the easiest way to remember the difference is that a subsidized loan is the government is subsidizing it, which means they're helping pay. And that is they're helping pay interest while in school. And then on the flip side, the unsubsidized loan, this is where the meter starts running immediately. And that is from day one. interest starts accumulating, and whether you're paying on that or not.
Yeah.
Okay, so does that feel pretty simple?
Yeah, and basically, some when people do that, and you're looking to look at the subsidized simplest on the Fed, that's coming through FAFSA versus their Bank of America. All these companies, they provide student loans, and you can get those in the unsubsidized private market. But it's just like you're going to the bank and getting a private loan. As soon as you draw that money, it's earning interest. So if you are a freshman, by the time you graduate, your initial loan could have potentially doubled. You're thinking, oh, I only owe $5,000. That was a small loan I got.
Yeah.
Well, it could be 10 now by the time you graduate if you take 4 years of unaccrued interest.
Yeah. It seems like these topics get so complicated, but if we can just take it back to principles that we already know. So again, federal versus private. Well, if you had to walk into the bank and take a loan, what's going to happen? You're going to start having interest right away.
Yeah.
So again, subsidized and unsubsidized ties back to that terminology on the federal. So let's get into this here and talk about that whole concept of who, what, where, when, and so forth. So who is the money being paid to when you have a loan?
Yeah. So on the federal side, they're going to be more critical on, they want you to run a little bit through the university. If there's any excess, though, you will get it refunded back to you.
Okay.
A really fun college story I had. I was at Washburn and we were in the fraternity, and this I won't mention his name today, but he didn't have a car, and he wanted me to take him to the bank because his Aunt Sally gave him a check every semester. And it was like 10 grand. And I thought, dang, I'm a freshman. I didn't know. I'm driving in my truck there. You got a really cool aunt. Unbeknownst to me, that was Sally Mae.
Oh my gosh.
That was the loan. And he was like, aunts. So in that market, you could take a loan, and I was blown away by this. I was, this naive freshman, and I was blown away. You could take a loan in excess of your college cost to cover your living. And he got this check from $10,000 from his Aunt Sally. And he was telling me how he had to deposit this check from Aunt Sally. And I was laughing. I'm like, dang, man, you're pretty fortunate to have this aunt, No, it was Sally Mae. And
did he ever own up to that in that conversation?
Yeah. I mean, as I got older, I think he just didn't understand. I was just naive enough not to know that he was talking about Aunt Sally Mae.
Yeah. Yep.
But it was so funny. I probably haven't thought of that story in 20 years, but I just remember him saying, oh, I'm like, man, your Aunt Sally gives you $10,000 a semester.
I
crazy.
Feel like I too have stories of people who had excess and they were the best dressed in the sorority house. I'm like, something doesn't add up here.
Car, new cell phone. You're like, man, what's going on? I thought your Aunt Sally was a generous person until she wants to be paid back. And I don't know if he's enjoying that experience as much now, but I remember that trip now to the bank. I thought, man, your Aunt Sally. But so federal loans are going to go through the university generally. And then if you do have loan balances in excess, they're going to refund back. Private loans will distribute those loans. I mean, it's a private loan that's distributed to you personally. So potentially that wouldn't go through the university, but generally the Fed's going to win. And because they like to see that you are enrolled in a university.
Sure. So, okay. So I receive this money as a college student. Am I taxed on that?
No, because it's a loan.
Okay.
That money is coming back. There can be potential taxability. We can talk a little bit later about cancellation of debt, loan forgiveness, and those pieces can create taxable income later on if you don't pay those loans back and maybe somebody else pays them on your behalf.
Okay. So how about this interest? Do I have an opportunity so interest is growing.
Yep.
Do I have an opportunity for like a deduction with that?
Yes, but you have to pay. So it's based on cash basis. So when you pay that interest, it is going to be deductible to you. You're going to get a form, 1098E. It's going to show your interest that you're going to pay into that piece. So you're going to get that from your provider, and it's going to say, okay, here's your interest that you paid. An interesting kind of caveat, let's say in the private world, the amount that you pay up into the original principal balance is considered interest, even though when you graduate, let's say I took $5,000, I owe $7,500 now. All the money you pay until the $5,000 will come on your 1098E as interest, because it's accrued interest, even though you're looking at it as, oh, my balance is $7,500 now, and I'm slowly taking it down. It'll be considered interest until you get back to your original loan amount.
Okay.
And max deductibility of $2,500 per year.
Okay.
And that is single and married. So if you have two single individuals recently graduated from college, they're paying their student loan interest. All of it in essence is interest because we have this accrued interest. You're going to move the deduction from $2,500 each to $2,500 combined.
Feel like I just got cheated.
Yeah. We call it the marriage penalty. And what's even worse on that side, if you're married filing separate, no deduction. It's just not eligible. So student loan interest is not eligible in married filing separate.
Okay.
And that's The worst case scenario we see that is when you have income-based repayment plans. So you're having to file separate. So we're not combining the household income to make that student loan payment higher. So we've separated the returns to help there. But now both of you who are paying student loan interest that are on income-based repayment are not getting any deduction because I'm filing separate.
Okay, you just said something there. Income-based repayment.
Yep.
Yep. Tell me about that.
So when you graduate, they allow you the options, particularly more in the federal world, that you can do an income-based repayment. Your student loan monthly payment is based on your income.
Okay.
And now when you sign up for that program, that's not like an annual basis. You have to sign up for the longevity. And once you get to a certain amount, I think it's 10 years, it's either 10 or 15. You pay 10 years at this income-based repayment, regardless of where your principal balance is at, they will resolve your debt.
Okay.
So if you were, I think there are some industries that is better. Sometimes in education and then teachers, social workers, some of those industries, maybe you're in the nonprofit world where you may not earn as much, but you maybe require a master's degree. Maybe you're going to require a doctoral degree, such in the social work world. So I have this really, really expensive education, but I want to work in this industry for the greater good, right? And I want to help people that need help. So I may not have the compensation because in nonprofits we're dealing with fundraising and that there's really no functional source of income for the business. So it hurts their ability to pay. So if you go into those sectors, there's some of these programs in there. And then also like there's rural sectors, public sectors, if you work in there for so many years, and they will kind of write off that student loan balance if you commit to those things.
Anything that you should know about programs like that?
Critical more on the hiring process we see in the medical field more is if the employer is offering you a benefit and giving you a bonus maybe per se to help you pay those student loans, they're going to pay them. Be critical about is that taxable compensation, because I've had a couple medical practitioners, more in the medical world we see where they'll say, hey, you've got this $250,000 student loan debt. I'm going to help you pay this off over this period of time, and we're going to pay this much per year. Well, that's compensation because they're exchanging that for your service. So they're going to either 1099 you or add that to your W-2. And it's hard because it's tax you're paying on money you never received. If you win the lottery, it's easier to pay the tax because I got the money. But if they took that lottery winnings and paid the bill on your behalf, and then you got to pay the tax, it's harder to come up with the tax. So just make sure you're communicating that employment offer, and maybe you need to adjust because you're thinking in your mind, well, I'm getting $20,000 paid to my student loan. Yeah, but you owe $5,000 in tax, so maybe I should have had them pay $25,000 to me and withheld $5,000, so I didn't take the burden as much.
So I feel like what I've heard you say on a lot of this is if there is what looks like income coming to me, really understand how that shows up from a tax perspective and what you might be
and I think the most critical thing with
for.
this and a lot of tax pieces is a fact check.
Yeah.
The fact check of what's going on, because your situation, you go talk to your buddy, oh yeah, he did that. Well, I had a lady come in and goes, well, why do I have to pay tax on my Social Security and my friends don't? We got more income. You know, like, so your situation, no one's situation we do is really the same. And there's just always a little caveat because your age is different. Your deductions are different. Your income's different. So just making sure you're fact checking, and even though what you hear today, if it ponders any questions to you, reach out. Let's find a time to like go through your specific scenario, because even though the American Opportunity Credit exists and we go through the details of what that is, there's eligibility, there's phase outs. There's also other provisions in there that are unique. There's a whole list of questions on American Opportunity Credit. If in a prior life you had a felony or something happened here, there's other eligibility requirements that are in there that are much more nuanced that you may say, hey, I checked all these boxes, but maybe I'm not eligible.
Speaking of kind of this topic, you and I were talking about how so often people get their information from TikTok as an example, or Instagram or something of that nature. And that information might not actually be accurate. So give us some of the risk, especially as it relates to the tax conversation. Because, you know, we were talking about real estate is how it came up. But the reality is people are getting their information regarding their student loans, anything that there's an opportunity for money here.
We started for a while. I remember we used to joke about, it was Google, and Google came out. And everyone's like, well, I Googled it. I'm like, well, Google's idea, the whole algorithm is set up. What I type in is what it finds. So if I say that John Doe was a professional athlete, they're going to find John Doe, the professional athlete, may not be the John Doe that you wanted.
Sure.
And the same thing with the tax world, we're seeing in TikToks and in AI that you got to be really careful. That guy that's on TikTok, likely if he's a real estate professional or something, and he's telling you something, or he's on Instagram, why isn't he doing tax laws of business then?
Yeah. Yeah. So
So just
be wary of
be wary.
what's
Yeah,
out
I
there.
think it's great for opening the conversation. There are some things that can be great planning points for there, but you got to work with a tax professional,
Yeah.
especially if you're a small business owner, you're involved in any real estate or that piece. It's way too nuanced to think that you're going to be able to guide through these paths on your own.
Absolutely. Well, as we wrap up, I think we've covered a lot of good information and a lot of things that you really can latch onto and make sure that you can figure out if it does apply to your situation. And again, coming back to working with a tax professional
Yeah.
and see if it does. What would be one piece of advice that you might give to a parent or student as we wrap our conversation up today?
So when you asked me this today, I thought we'd go through, I says, it's just to be college poor.
Yeah. What does that mean?
Enjoy the ramen, enjoy the white rice. You're eating canned tuna. It's fine, because outside of the scholarships and grants, the worst thing I'd want to see someone do, and we saw people that we went to college with, we joke about the Sally Mae guy, like, don't pay for this forever.
Yeah.
See on when you're going to, and it's fun, you're graduating high school. And I think there's a lot of unknown pressures that we put on that high school senior, because every person that goes to graduation party asks, what are you doing? What do you want to
Yeah.
be? I never woke up and said I want to be a tax accountant. I didn't wake up this morning and say I want to be a tax accountant. So I think we put that pressure there, and that students put into a tough role. Not saying that we just want to let them go there, but go there with a general plan of how we're going to repay this. And
Yeah.
that's an important piece to do, that we don't just want to go there and pay for the college experience and then pay for it, and pay for it, and pay for it. I've had friends I go to college with that are literally living overseas because of the inability to pay it back. And so I don't want to see people do that. And I say embrace it, because I think it creates that grind and go through and laugh about later in life that,
Yeah.
I did that a lot when I was in college. White rice, tuna, and black bean. I mixed it in a bowl, and that was like a week. You know what I mean? So, I think embrace that. I think it's better to go through that experience, so that when you get to other phases of life, I'm never one that's like, I want to go back to college. That was the best time of my life. No, it wasn't. I was so poor. I
Yeah.
ate so poorly, and I got through it, and it was hard. But now, because I didn't take on all those loans and pieces, my financial flexibility to buy a home and go through some things is so much better. I remember we were at a
Yeah.
graduation with all of our buddies. One guy said, "Well, I had a great time." It was an interesting thing, because none of us had discussed our debt.
Okay.
And you're in this fraternity together, and one guy goes, "Yeah, but I had a great time." And we were like, "Yeah, but I'm gonna own a house."
Yeah. Sure.
Like, that's the difference of what
It's
this
the bigger
cost is. And
picture.
when you graduate, if you today and the cost of things, you don't want to end up with a $400 or $500 payment. And when you look at these things, you're getting 6 months.
Yeah.
Now, I remember that 6 months after you graduate, that student loan company's called and said, "Okay, congratulations. Now we want our money back."
Yeah.
And so that's not a lot of time to figure it out in today's time.
I often talk about how I had a misconception that retirement planning started closer to retirement. And the reality is retirement planning starts really the first time you start earning that paycheck and
Yeah.
have an opportunity to use a 401k and so forth. And when you talk about having the debt, that eats into the longer term
Yeah.
picture. And while most people have a really hard time associating with that that goal that's so far out, the immediate is, control what you can control today. And that is partially of be college poor. Back to your point.
I
And
think we've just done a poor job of if you've been in home lending or buying a home, how hard that lending is. Then you get to the next step. If you try to do business lending, even if you're established, how difficult. They want 20-30% down and all these components. But we give student loans with people with no income, no ability to repay, and as much as you want. And so, because that's not regulated probably as firm as it needs to be,
sure.
you got to do it yourself. You got to do it as a family. You got to use your advisors to make sure we're not setting ourselves up to a position that's untenable. Because the worst case, when you get those, we see clients that come in, they're young, they just graduated, they're kind of wanting to maybe get that car or finance there and go through in that home. Well, that student loan debt's the worst debt, because there's no collateral to it. There's no asset. So it puts you in a position where most college-age kids are graduating college bankrupt.
Yeah. Yeah.
Because your student loan debt is in excess of any of your assets.
Yeah.
So it's just weird to think that if you graduate college with student loan debt, we're starting all of our kids off bankrupt.
Yeah. Nobody phrases it like that.
And then you're supposed to dig out of bankruptcy
Yeah.
and to have financial prosperity and be retired. But we're like the student loan system. It's a debt with no asset. Now, at the threshold I had, I used to tell myself, well, there's no better thing you can invest in than yourself, but there needs to be a balance to that. If you don't have the means to do it, and you've got a degree you're going to get to that you're focused on, you're going to get that done and take care of time, and you're going to get a job and pay that back, go get it. But if we're wavering a little bit, be careful about what university you get to and cost on that side, because as soon as you take that first rump, you're basically bankrupt. And it's a weird thing to unwind out of.
I have to say that is almost like the perfect ending to our entire series that we have had, where we started with the college student's perspective and then have wound all the things about building the right skill set to take with you after the college years and how that plays into the financial decisions you made. And so kind of my last aha moment here is, if it's the concept of starting out upside down or starting with the terminology bankrupt, you're digging out of a hole. And so what a way to end this. And so any other thing that you want to add before we wrap up? If not, I'll go ahead and go to our closing here.
Just make sure if you do have any questions, just reach out.
Yeah.
That's the best thing, and don't feel there are no dumb questions. It's impossible to have all the details. And we may not have all the answers to your solution, but connecting with your university and making sure your best plan is planned.
Yeah,
right.
Absolutely.
And so to just go there, and it's fun, right? They're going to show you the rec room. They're showing you the dorms. University, I think about it now, they don't take you around the classrooms.
Yeah.
Right. It's all about the dorms,
all the highlights, all the fun that you
look
can.
at the sports teams in there, but we don't talk about paying it back, what that looks like. We don't talk about the class, the hard work, making sure, because college has gotten, now I look, when we went, it was cheap, but then because our parents used to say how much cheaper it was for them, and now it's man, it's just tricky.
Yeah.
Making sure when you're taking that and you're signing those things, and on the student loans, the parents and student, who's liable to pay back? Because on the federal side, we talked a little bit earlier, was if the kid doesn't pay it back, the Fed can take it out of the parent's Social Security. So just be critical when we're looking at those pieces. It's not, I don't want to say don't feel pressured. You got to do it to put your kid through college. There's other ways to also make it work.
And that's something that Jeff Foley, one of our advisors and the owner of Paladin Financial, has actually spent quite a bit of time going through recently. He has done a series of social media posts on that, as well as was recently on here in the Twin Cities on Care 11, talking about that concept of making sure that you can pay for your own retirement potentially before paying for your students' education. Well, with that in mind, there's one thing that we like to offer our listeners as a resource before, or as we go along with this series. And this month we're offering, what issues do I need to consider as my child becomes independent? It's a checklist that we make available. And so it includes important conversations around access to financial accounts, health records, academic information, emergency planning, and so forth. And that resource is available for download on Paladin Financial Talk. And William, it's been an absolute pleasure having you. If our listeners have felt like, oh my gosh, this conversation has been fantastic, it resonates with me, one of the things that we like to offer is a 15-minute complimentary consultation. And so you can go to our website at Paladin Financial Talk or paladinfinancial.com, either one of those, and access our booking tool for 15 minutes. We can also make the introduction to William and his team, or you can find them at simmonsandsimmonsinc.com. All of these links are available on paladinfinancialtalk.com. And so thank you again for listening. William, thank you for being with us today, and we'll see you on the next episode of Paladin Financial Talk.